Hey guys, welcome to the fourth chapter of the Fin module, which is on income taxes. So this is dealing with the accounting treatment of an entity's income tax, and this is known as tax effect accounting or tax accounting. And basically what this does is it's trying to figure out what is the correct way for accounting to treat the inherent differences between tax and accounting profit. So as you all know, you lodge your tax return based off taxable income, and that's based off tax laws in the respective country or jurisdiction that you're actually in. Accounting profits based on the accounting standards. So there are some inherent differences. There are some differences which is just a matter of timing, in terms of, next year we'll have over 5 years that both methods will result in the same result. There's some methods where it's exactly the same, and there's some rulings and methods where they will never be the same, and these are called non-temporary differences. So, let's go through each of these in a separate example so you can see how they work in real life. So let's start off with the most uncommon approach, which is basically where accounting and tax are exactly the same, and you'll rarely see this in real life simply because all the accounting and tax rules, it's very unlikely that you'll find an entity that all of these align. So in this example, we've got an entity which has got $1 million net profit, and that's it. Their taxable income is exactly the same as their net profit. So very simple. The first step is always to calculate what this line is. So it's the current tax liability, and what that means is it's the dollar amount of tax that an entity will have to pay in the next 12 months. That's what that item should reflect. Now the income tax expense is basically how to treat that amount in through the P&L. So it doesn't always equal that $300,000 depending on where the net profit differences come from. For example, there might be a section from OCI, etc., or even equity. But in this example, the whole $1 million comes from the P&L, from the accounting numbers. Therefore, the income tax expense is exactly the same as the current tax liability. Okay, so that's the simplest example. That's scenario 1. Scenario 2 is where the accounting and tax treatments will never be the same. Now, a good example for this one is either entertainment or fines, because in both of these instances, accounting, both of them will be an expense. It'll show up in your P&L as an expense, which will reduce your accounting profit. For tax, however, there's specific legislation which means that these will never be deductible. Fines and penalties will never be deductible because they are not incurred in generating income. The other one is entertainment, which there's specific legislation which says this is only deductible under certain rules that you paid FBT, etc. You don't need to know the details of this. They don't expect you to have done the tax module before you've done this module. So they'll actually tell you exactly. So in this question, they've actually said included in the profit is $200,000 in entertainment expenses that will never be deductible. Okay, so they actually tell you how to do it. So the way we do it is, first of all, we start off with our accounting profit. Then we add in our differences, whether they're permanent or temporary. In this example, we're only doing with permanent differences. So we've got our entertainment expenses of $200,000. Therefore, our taxable income is $1.2 million because for tax, they're not allowed to use this deduction. Now, we calculate, first of all, our current tax liability. So it's $360,000. That's the amount of tax they'll have to pay at 30% of their taxable income. Now, let's go to the P&L side. Again, super simple. All of that's coming from accounting profit. There's no OCI. There's no equity component. So again, income tax expense, $360,000. That goes to the P&L. That goes to the balance sheet. Super simple. Now, they've gone through another example where accounting and tax treatments of an item are the same but are recognized in different periods. So I mentioned this before. These are called temporary differences. So an example would be a different depreciation rate for a tax and accounting. So you might get accelerated depreciation for tax but not for accounting, but over 5 years or 10 years or whatever the life of the asset is, you're both going to get the same dollar value of depreciation. So either way, it's exactly the same over the long term. It's just in the short term that there's a difference. So this is a temporary difference. There is a long list of these examples. You don't necessarily need to know them. They'll tell you in an exam. And it does actually say here the examples are not exhaustive. So what I would just recommend is just understanding the concept, and then let's move on. So it's basically exactly the same approach to what we talked about before with permanent differences. It's just making sure you understand, I guess, what the difference between tax law for permanent and temporary differences. So in this example, we're just going to go accounting profit less the tax adjustment, which is $100,000, less of revenue, which is not assessable for tax yet. So they've actually got lower taxable income for tax. Exactly the same approach. So it's just what's your current tax liability? So it's going to be 30% of the $900,000. And then the other side is income tax expense, because it's all accounting profit. There's no OCI. There's no equity component. Okay. So just moving on. So this is where transaction is recognized outside of profit and loss. So what this is saying is we're going to look at some different examples where it's not just going to be income tax expense. Current tax liability is always going to be the same because that reflects the dollar amount of tax you have to pay. However, sometimes some of that amount that you're paying on tax actually comes from OCI or somewhere that's not in the P&L. So it doesn't actually make sense to code tax expense where the original numbers actually aren't coming from the P&L. So why should that go in the P&L, you know? So let's look at this example. So in this case, they've actually had accounting profit of $1 million, so nice and round number. But for tax purposes, they also have to include this $60,000 gain relating to fair value movement on a financial asset. Generally, you don't include gain fair value movements into your tax return, but for financial assets, there are some specific tax rulings, so it doesn't come up very often, but it is just using this example just in case the very rare situation where this does occur. And they will tell you exactly what to do. But just keep that in mind as a bit of background information. So in this case, accounting profit's $1 million, but for tax, they also have to include this gain on the financial asset. That's probably the key one, because a normal asset probably under tax, you wouldn't need to include this in your taxable income. Anyway, so your taxable income is higher than your accounting profit. So same approach, we always look at our current tax liability, 30% of taxable income. Super simple, it's $318. Now, how do we split out income tax expense? So, income tax expense, as I said before, is only impacted based on your accounting profit. It doesn't make sense that anything outside of your P&L, your accounting profit, should be reflected in your P&L, or your accounting profit, through the income tax expense. So what we're going to do is we're actually going to go 30% of $1 million going through our accounting P&L. That's where that comes from. And the other side is going through our OCI reserve. So $18,000. That's just 30% of that $60,000. And you can see the notes down here. The accounting treatment of assets categorized as fair value through OCI is covered in Unit 9. So we'll talk about that a little bit later. As long as you understand the concept that you shouldn't punish the P&L unnecessarily, because that source accounting profit isn't coming from there. So why should your income tax expense be higher? And the last scenario, which is just a little different, is where instead of OCI, you've actually got an assessable amount of income from equity. Now, this doesn't happen very often either. It's only in very specific situations. And the most common one is actually share costs, because there are actually accounting standards, which means that costs or expenses around shares need to be allocated to equity, not through the P&L. Now, tax law sees that a little bit different, and they think that, it's a genuine expense, that's a genuine deduction. It means your taxable income is actually lower by $80,000. Therefore, similar to the OCI situation before, we do our normal approach for current tax liability, because it's the dollar amount you got to pay on your tax return. It's just the 920 1060. So it's just going to be that number there times by 30%, and then just splitting out the accounting profit income tax component, so it's 30% of that, and then the other side is the reduction due to equity, so it's just 30% of that. And that's basically how we get to this figure down here. Okay, so that's covering off basically how to calculate income. It basically covers off how to calculate current tax liability. So now we're going to move on to tax losses, again under the topic of current tax liability, because under tax law you can use previous year's losses to offset current tax liability. So how do we account for that? Basically, there's two scenarios, right? Let's first of all just look how it works. We've got taxable income of $100 million. In previous year, there was tax losses of $200,000 carried forward. So your taxable income for this year is actually $800,000 after the benefit of the losses. So your tax liability is only 30% of that, which is actually 60 grand lower than what you would have otherwise paid if you had paid 30% of that. Keep that 60 grand figure in mind later, because I'm going to talk about that in a second. So how we account for this really depends on whether we have recognized this loss as a DTA. Now, you might be asking me, Max, what's a DTA? Well, we've only talked about current tax liability as up until this point. The next section we're going to be talking about after this is deferred tax liability. So it's actually your tax assets and liabilities after 12 months. So it's a future amount which is recognized in your balance sheet. So current tax liability is pretty simple. It's just your current year. DTA, DTL is your future. Now, this is saying if the carry forward tax losses has previously has not been recognized as a DTA, which is an asset you can use against your future tax. So if a couple years ago they had not put that in their DTA, which they probably should have, this is the journal you need to write in the current year, which is income tax expense, 240, current tax liability, 240. Just the usual. It's just the 30% of the $800,000. Normal approach, as we talked about before with CTL, current tax liability. However, if the carry forward tax losses had been recognized as a DTA, it's a little bit different because we actually have to go back to find that amount in the balance that is in the balance sheet and reverse it out. Now, how much do we have to reverse out? I talked about the $60,000 figure before because that's the difference that they would have recorded, and it's basically at the current tax liability rate of 30%, what the difference was between the $1 million times 30%, which is $300,000, and the current tax liability, which was $240,000. So basically, they would have recognized $60,000 as a future asset, or a deferred tax asset. So let's have a look at how they've approached this journal. So the current tax liability is always $240. It never changes. It's always the same. So it's 30% of your tax liability. So $240. Now, the deferred tax asset. The deferred tax asset was the difference between the two. So it's basically, or in other words, it's $200,000 times 30%, because you want to recognize it after tax, not before tax. So it's $200,000 times 30%. And the difference just goes to income tax expense. So those are the two situations. Okay, so let's move on to the next step, which is a bit harder. It's deferred tax. And just to recap, current tax liability is anything that's in the first 12 months. Deferred tax is anything after that. So it's basically longer term, either tax assets like a prepayment of tax or a tax loss carried forward. And the other one is DTL, which is a tax, or it stands for deferred tax liability. So it represents a tax benefit that the company has received in advance relative to their financial accounts. So if you look through the CSG, yes, they explain it, but it's a little bit complicated. And it's not the most clear thing. So what I'm going to do is I'm going to skip all this stuff. I'm going to tell you straight away how you can do this quite easily. And I'm going to show you this other resource which I've provided. I've uploaded it. So just have a download of this document. So what this document does is it does two things. It's a really easy way of calculating current tax liability, which we talked about. It's not that difficult though. And the other thing it does is it provides this really useful table for calculating deferred tax. Now, I'll probably just skip over this current tax liability because it's kind of simple to use. It's basically just accounting profit, as we talked about. And then you do your different adjustments for non-temporary, where they're never the same. Temporary, with just a different timing. And then equity OCI adjustments. So they all contribute to taxable income, as you can see. However, the journal is probably going to be a little bit different depending on whether it's comprised of temporary differences, i.e. just accounting profit, or whether there's a component from equity or OCI actually impacting it. So really simple. Once you've calculated your taxable income, you figure out what your current tax liability is. So it's just 30% of that taxable income. And then you put in the journal. So it's current tax liability 30% and income tax expense 30%. Of course, you have to adjust that depending on whether there's an OCI component or a share or an equity component in there. So you just reduce the income tax expense or increase it depending on what the dollar amount is for OCI or equity. So really simple. However, this bit's a bit harder. So this is actually the deferred tax. So the way we calculate deferred tax is, first of all, we need to figure out a list of all of our assets and liabilities, and the question will actually give you these figures. So you've got all your assets, you've got all your liabilities, and any income adjustments, but generally it's just going to be assets and liabilities, because you need to figure out how much depreciation, for example, have I accrued for finance on these assets, and how much depreciation have I accrued on the tax base. So basically you're going to be comparing the written down value, i.e. the current value after depreciation, for financials or accounting standards and tax. So we're comparing the two and seeing which one's higher. So that's what these are doing. Sometimes you need to calculate this. The exam might give you just the inputs to calculate this yourself, like the cost, date, depreciation rate, depreciation method, etc. So you might have to actually calculate these yourself. Sometimes they just give you the number. Either way, populate these two columns with your list of assets, liabilities, and your list of carrying amounts for accounting and your tax base. Now, the next step is to actually look at this table in the CSG. So we've got to figure out whether it's actually going to be a DTL or a DTA. And there's also this thing here, temporary difference or taxable temporary difference or deductible temporary difference. So what do they mean? So DTL, DTA, you already know what that means. It's basically the deferred tax that you're going to have to pay. Taxable temporary and DTD, I always get confused by these, but it's basically the same thing as a DTL, DTA, but it's before tax. So it's a larger amount. So in this case, for example, for a value of an asset, you literally just minus carrying amount from tax base. That's your difference. So it's either going to be a taxable temporary difference or a deductible temporary difference. I always get confused by those names, so I just refer back to this table here. So for an asset, let's use the example of an asset which has had a higher rate of depreciation for tax than accounting. So what that means is the carrying amount for finance or accounting is going to be higher than the tax base for tax. So we're going to put those numbers in. So this one's going to be higher than this one. And then what do? We figure out whether this results in a TTD or a DTD. So we've got to figure out where we're going to put our difference number in these columns. So for an asset, the carrying amount is higher than the tax base, so it's going to be a TTD. So let's follow that ruling. So it's going to be a TTD. So we know it's going to fall into this column. So what we're going to do is we're going to write the amount in here, in this little box here. We're not going to put anything in there because there can only be one or the other. So there's going to be this one, and so forth. So fill out each of these boxes depending on where they fall. So that's the first step. The next step is to add them all up. So total all of these columns here and total all of these columns here, because we've got to figure out what's our DTL and DTA going to be. So it's basically going to be 30% of each of those. So once we've totaled that, the next step is to figure out what our closing DTL and DTA is going to be, because how do we calculate that is times it by the tax rate. So it's going to be that times 30% or whatever the tax rate is, and that times 30%. So that's our closing, which is this line here. Now, the next step is to actually reduce the opening balance of what it started with. Now, the reason we have to do this is because for the journal down here, we're only going to be recognizing the movement so we can get what the balance sheet item number needs to be. And that's basically going to be the opening plus the movement. So that's why we need to know what the movement is. So we've got our DTL, what it should be, and then we minus that from the opening of our DTL and opening DTA, and that calculates our movement. Now, these movements just go into the journal down here. So A goes down here and B goes here. And the difference just goes to income tax expense, either debit or credit. And that's pretty much it. That's all you have to do. It's not as hard as they make it in this CSG. It's very difficult to follow. And that's the rest of the chapter. That covers everything. The only other thing that I probably will touch on is just this revaluation surplus amount here. So what I will briefly mention is how do you account for when you've actually done a revaluation of land or similar asset. So you may be aware, and I think we'll cover it later in the CSG, is that when you have a land or similar asset that you need to revalue every year so that you reflect fair market value, the journal for that's actually debit the asset, so increase the value on your balance sheet, and credit revaluation surplus. So this is where the revaluation goes, and this is actually an equity account. What you might not be aware of is you actually have to reflect a DTL component, or the tax component of that revaluation as well. So what you actually have to do is do 30% of that revaluation, because you need to put a balance aside, similar to how we were doing before, of what our future tax is going to be when we actually sell that asset. So if you've got an asset you bought for $1 million and its current value is $2 million, you know that you're going to have to pay, when you sell it, 30% tax on that, basically, less your opening cost. So what we need to do is make sure we've got a reserve in the balance sheet and report to investors that we know that in future we're going to have a deferred tax liability, or a tax liability greater than 12 months down the track. So this is basically what this is doing. So the journal for that is 30% going to DTL, because it's not current, it's future, and the other 30% is actually going to offset our revaluation surplus, which is a reserve account within equity. So actually, when you combine the two journals, it's actually going to be debit land $100,000, credit revaluation surplus $70,000, because this offsets that, and the other side is going to be a DTL of $30,000. And that's basically what this journal here is saying. So it's saying, assuming that you've already done the journal for the original increase of $100,000, you need to also post a journal for the tax component, which is the 30% of the increase, so $30,000, and debit revaluation surplus. Of course, this is subject to what previous revaluation adjustments have been, because this can actually impact your journal. Just be careful to read that text as well and check if there has been a historical revaluation. So that's pretty much it for the income tax chapter. It's really all the key things. There's nothing else you really need to know. There are some sections at the back of the CSG about disclosures and presentation and things like that. I don't think it's too important. I don't really think I've ever seen it in an exam, but maybe just read through it for your own benefit. But I'm not going to go through it in this particular video. Okay, thanks. I hope you've learned a lot from the income tax chapter. And we'll move on shortly to the next chapter, which is on foreign exchange. Thanks.